Good morning, good afternoon, good evening, and Happy New Year. I'm Nicolas Véron. It's my pleasure to introduce this first session of 2024 of the Financial Statement Series at the Peterson Institute. And we're going to look a little bit back to 2023 today because we're going to comment on an event that everybody remembers, a story with Credit Suisse and its state-sponsored takeover by UBS in March, but also looking forward at what are the lessons for Switzerland, but also for other jurisdictions from that significant, momentous event. We couldn't have better speakers today than Eva Hüpkes and Jérôme Legras. Eva Hüpkes studied law at the University of Passau in Germany and at the University of Geneva, the Graduate Institute in Geneva, Georgetown University, and the University of Bern, where she had her doctoral thesis in, I think, 1999 on, I quote, the legal aspects of bank insolvency. So that's good preparation. And at the same time, in the late 90s, Eva was a consultant to the IMF. She participated in the research on the Asian financial crisis, which had happened just before. And then she joined the world of banking supervision in 1999. She became the legal counsel at the Swiss Federal Banking Commission, which is a predecessor entity to the current Swiss financial supervisor, FINMA, which was established in 2007, I think. She was also the secretary of the Expert Commission on Bank Reorganization and Liquidation already in 1999. And then she worked at FINMA for a decade as in her last job there, head of regulation and head of policy. In 2009, Eva joined the Secretariat of the Financial Stability Board, which had just been upgraded following the great financial crisis in 2008. And she held a number of positions there, including head of regulatory and supervisory policies, but perhaps more substantially, she was really the driving force behind all the Financial Stability Board's work on bank crisis management and resolution, and particularly the first global standards on these issues, named the key attributes of effective resolution regimes, first published in 2011 and updated after that. And just last year, in 2023, Eva Hüpkes became the Secretary General of the International Association of Deposit Insurers, which is also in Basel, like the Secretariat of the Financial Stability Board, but is a separate entity which, as its name indicates, brings together the world's deposit guarantee schemes, but also with increasingly a role in coordinating policy about bank resolution. And of course, Eva Hüpkes participated in the expert group in Switzerland last year that was assembled after the Credit Suisse episode, but she will explain that. Jérôme Legras studied at École Polytechnique, as I did. He then studied at NSAE, which is a statistical higher education organization in France. So he has very much of a quantitative background, and after a few years, joined Société Générale, a Paris-based bank, where he worked for 11 years in quantitative credit research and then in structured capital finance. Then in 2013, more than a decade ago, Jérôme joined Axiom in Alternative Investments, which is a research and investment firm based in Paris, where he is managing partner and head of research. But I should also say that Jérôme is well known in the bank capital community for his incredibly deep and broad expertise. He writes regularly in the Financial Times about those issues, of course, everything having to do with equity analysis of banks, and therefore also a great witness to what happened last year in Switzerland. Eva, over to you.
Well, thank you very much for this introduction. It's a pleasure to be here and to share some reflections from the review of the Credit Suisse case on the lessons learned for supervision and resolution, and having not only on the this independent expert group set up by the Swiss Federal Council, but also been involved in the preparation of the FSB report on the lessons or preliminary lessons learned. I think I will share some of these observations that actually fairly align fairly well between those two groups. And of course, my remarks are personal ones. I'm not speaking for the International Association of Deposit Insurers, the FSB, or any of its members. And I should also note that this expert group was tasked not with a post-mortem analysis, but rather was asked to take a forward-looking approach and offer some reflections on the future. So I think, Nicolas, you're sharing my slide. So if you could move to the next slide, slide 2.
I'm a little bit technically challenged,
Okay.
but I'm sure I will overcome.
It's a polytechnique for you, huh?
Yeah, exactly. So bear with me, but go ahead, Eva. Sorry.
Well, I mean, this slide, which is actually also in the report, just as a reminder that the Credit Suisse failure was an idiosyncratic crisis that evolved over years and driven by long-standing business model and internal governance issues, which then led to an erosion of confidence. The losses due to Archegos and Greensill failures in 2021 reflected a lack of effective risk culture, management and controls, and there were many changes in risk and compliance leadership, a fast turnover of senior management, for instance, 3 different chairmen in 3 years, 4 CEOs in 7 years, lack of sustainable profitability eroded clients' trust, and then even a proposed restructuring, a revised strategy and a capital increase then in December 2022 did nothing to restore confidence. And so just despite the actually still solid capital and liquidity figures that were reported, Credit Suisse did not have the strength and the ability to manage a turnaround. The outflows, significant outflows of funds continued in the fourth quarter of 2022, and then obviously in March last year. And then on the 15th of March, you may recall there was a statement by FINMA and SNB confirming that Credit Suisse still met capital liquidity requirement. The Swiss National Bank was ready to provide emergency liquidity assistance and did so, 50 billion. But at the same time, for instance, when you looked at market indicators, CDS spreads, their markets had different beliefs that didn't align with those of the regulator. So a stark contrast here. Regulator statement and market indicators. And then maybe if you could turn to the next slide. And before turning to the possible lessons learned, let me just briefly recall the actions taken by the Swiss authorities. So on 19th of March, UBS concluded this merger contract, which was then fully completed in June of last year. And well, this was a state-assisted or state-sponsored merger. The actions taken were based on the federal constitution that grants powers to the government to safeguard the public interest and grant credits in emergency situations. It was actually the same constitutional basis that was used to take the restrictive measures during the COVID pandemic. And that emergency regulation enabled the government to backstop liquidity assistance to be provided by the Swiss National Bank and to provide a default guarantee covering up to 100 billion Swiss francs. Then it enabled the government to enter into a loss protection agreement with UBS. So the Switzerland, the Confederation, would have had to bear 9 billion of losses arising from the sale of certain assets that UBS took over from Credit Suisse as part of the transaction. So UBS would have borne the first 5 billion of any losses. And the regulation also enabled the Swiss National Bank to provide additional emergency liquidity assistance, so-called ELA or Emergency Liquidity Assistance Plus, up to 100 billion, and this on an uncollateralized basis, just for the privileged creditor status. So this also in derogation from the Swiss National Bank Act, which requires lending being collateralized. And then the emergency regulation allowed for the merger to go ahead without the approval of UBS and Credit Suisse shareholders and without other requirements, such as the preparation of an interim balance sheet, and thus overriding provisions in the Merger Act. And finally, it authorized FINMA to order Credit Suisse to write down the AT1 and to approve the merger in lieu of the competition authority. So this failure resolution, or this approach that was chosen, departed from the preordained one under the resolution framework. It did address the bank's failure in a manner that maintained financial stability and prevented contagion. So in that sense, mission accomplished, it was effective, but it obviously created a new problem for Switzerland, a single global systemically important bank with assets double the size of the Swiss GDP, and the challenge to reestablish credibility in its resolution regime, as the same solution wouldn't be available. There is no other merger partner that'd be available. So moving to the next slide, a key question is, well, would resolution have been possible? Would it have been a viable option? Could the Swiss have, resolved Credit Suisse under the existing legal framework? Well, the short answer given by FINMA, and that has also been endorsed by the Financial Stability Report of last year, the expert group report, as well as last month's report from FINMA, is yes. Except, of course, for the liquidity backstop, which had been proposed but not been adopted into ordinary law. So the backstop would still have required emergency legislation. So the strategy, the resolution strategy that wasn't implemented was a single point of entry bank resolution strategy. It would have entailed the full write-down of capital, the full write-down of the AT1 bonds, the conversion of the bail-in bonds, so the TLAC, the total loss absorbing capacity, that had been issued by the holding company, and that would have then generated 57 billion in fresh capital.
Allow me to interrupt on this, Eva, because this is something where I've often noted understanding issues between the Swiss debate and the international debate. When what you call in Switzerland bail-in bonds, as you said, that's part of the TLAC. Is that basically a senior unsecured debt, or is it a different instrument?
Yeah, that's what it is.
Okay, thank you.
The holding company, yeah, that's the Swiss say bail-in bonds, but this refers to the TLAC instruments, as we call them for all GSIBs, and in comparable to MREL in Europe, which is slightly different.
Well, that's why I'm asking, sorry for the interruption, but because there is some ambiguity in Europe whether senior unsecured counts as MREL and whether it can be bailed in. So I see some gap between the Swiss and the European debate, but maybe that's me not understanding it well.
Yeah, well, maybe we can come back to this, but just to. Coming back to this question, would resolution have been possible, and why didn't the Swiss choose resolution? FINMA explained that this state-sponsored takeover was more targeted, more proportionate, and immediately instilled confidence in the Swiss financial system, which might not have been the case in resolution. Resolution would have had some uncertainties. Given that this was a liquidity, or seen as a liquidity crisis, one could have claimed a lack of proportionality given the intact capital base, and And also the execution of bail-in could have given rise to some operational or legal challenges, compliance with the securities laws of the US and other jurisdictions in this very tight time frame over the weekend had been seen as challenging by some. FINMA nevertheless stressed, well, having done the resolution work and having that resolution option as plan B was critical. On the other hand, execution would have been an opportunity to demonstrate to the markets that we truly ended too big to fail. So now some policymakers at international level also see this as a missed opportunity. And of course, the challenge now is in Switzerland in particular, but also internationally, to demonstrate that resolution does remain the preordained path for failures of global systemically important banks. So there is some work to do. There are nevertheless some lessons to be learned, and let me then highlight some for supervision, recovery, and then also discuss crisis management and resolution. And to start with supervision and recovery. So as mentioned earlier, it was on 4 days before this takeover or merger on the 15th of March, the Swiss authorities confirmed that Credit Suisse was still meeting the regulatory requirements. So, this shows that actually the regulatory metrics on capital and liquidity like CET1 and LCR did not really provide a good view of the health of the bank and its viability. Important amounts of capital and liquidity were actually trapped in entities, be it in the host jurisdiction or in the bank entity in Switzerland. So these resources were actually not freely usable where needed. A view expressed in particular in the expert group report, but also reflected in FINMA's report, is that we need to consider forward-looking information reflecting the anticipated profit growth, market signals, business model, looking at the credibility of strategies, the business and management, to determine its viability and the need to take intervention. And now that UBS is the sole GSIB left in Switzerland, with the total assets more than double Swiss GDP, resolution planning is critical. But I would say equally critical or even more critical is recovery planning. Credit Suisse had a recovery plan, and if you look at FINMA's resolution report per 2022, so which showed that per end 2021, Credit Suisse had a recovery plan, and FINMA uses this traffic light table showing, green, orange, red, and recovery planning was in green. So Credit Suisse had a recovery plan, but the question is, was there a mechanism to ensure that the bank implements radical recovery action in time and at a time where it's still possible before ending the point of non-viability? So that's certainly an important point, and the Swiss Banking Act does provide a legal basis for early intervention, but it's very broad and generally. On one level, you could say, well, FINMA has very broad powers, but on the other hand, having such a general legal basis also means that FINMA can easily expose itself to a legal challenge, and a bank that is sort of enforcement resistant will challenge FINMA's actions, and that is also what happened. So having specific qualitative and quantitative triggers, yes.
Sorry for interruption again. Did Credit Suisse actually sue FINMA in the past, or is it just implied they might?
That is something I would coming to later. That the enforcement actions taken by FINMA, with some exceptions, are generally not made public. So you can now read in FINMA's report how many actions had been taken, and it's also demonstrated that they had been challenged. These actions had been challenged, and so this is another issue that, I mean, FINMA enforcement powers need to be strengthened in such way that even if there is a legal challenge, I mean, the legal proceedings can be resolved quickly, because otherwise the enforcement action is not effective. But clearly this had been a challenge, and it's also probably had the effect that FINMA was reluctant to take action because of not having this very clear, specific legal basis. That's why maybe having very clear qualitative, quantitative triggers that in a way obligate or the authority to intervene and take action, and in a sort of structured way. So if these recovery actions are not taken by date X, then this happens, and et cetera, I mean, could have been helpful in this scenario. And so the recommendation that have been put will go into this direction, that sort of having a structured early intervention regime. Also, I mean, the ability to disclose enforcement proceedings. There is always concern about the adverse market reactions if there is a disclosure of some enforcement action. But I mean, you may recall that there had been this delay in filing of the annual report with the SEC, and that had actually then become public because the Credit Suisse did not file the report, publish it in time, because there were some SEC comments that needed to be addressed, and so that then did become public, and whereas maybe earlier actions taken by FINMA had not been made public. And it's important that action is taken at a time, and that's why I stress the importance of recovery when actually the ship, the situation can still be turned around, and not when it's already too late. Finally, I think it's let me also mention in this context liquidity. I mean, here FINMA had already imposed higher liquidity buffers, and that was certainly helpful. But I mean, we have learned not just from Credit Suisse failure, but also the US banking turmoil, that liquidity can and does disappear extremely fast. So we need to look at liquidity in light of accelerated bank runs, and the runoff rates assumed in the liquidity coverage ratio, LCR, appear low. So this discussion is happening at the international level, and another reform proposal that has been put forward is that of pre-positioning collateral, possibly with the central bank, so that to facilitate access to liquidity, and in all relevant currencies. It might also, and there may be other approaches as well that could help to address the stigma issue of drawing on the lender of last resort resources. And finally, and I'll certainly come to that also on this slide of resolution, which is slide 6, maybe, the importance of the public liquidity backstop, given that banks cannot self-insure for all states of the work, so there are clearly some limitations. And maybe quickly turning to resolution, I think the Credit Suisse...
I'd like to go to the conclusion, actually, because we have a limited time here, and there will be a number of questions.
Yeah, so sorry. Maybe then I'd rather maybe highlight a few things, because one is regarding the key question was how the Swiss authority reached the conclusion not to trigger the resolution plan, and why. And here, per Swiss law, FINMA should decide on entry into resolution. However, without access to liquidity, and if a resolution will fail, and I mean the Swiss National Bank would have to provide liquidity, but it wouldn't be able to do so without adequate collateral. So unless the state then agrees to provide a backstop. So clearly you have all three authorities have a role, and I mean there is no clear mechanism to determine how these authorities come to the conclusion to put a bank into resolution. And the question is whether this shouldn't be codified and be a transparent process. And maybe, yeah, I mean, on resolution, I mean, the focus is here on flexibility, modularity, questioning this open bank bail-in process, asking should we have use a bridge bank to in resolution to have more options. And maybe one point also just I'd like to stress relates to cross-border cooperation and communication. Swiss had worked very closely within the core supervisory college, the UK and US authorities, but Credit Suisse was a global bank. And when then the Swiss authorities communicated the assisted merger on Sunday evening at 7:30, that was already 4:30 in the morning in Japan. And so it is really critical that, I mean, the Japanese authorities are well informed, in particular had there been a resolution. So as you know, the reactions in markets, market reactions in the market where that opened first success of the entire resolution. So maybe let me then close here. I think, but I'd like to stress that the failure does not suggest that the international standard, the key attributes, and of course I'm not quite objective here. I have for purpose, but resolution does remain the expected path for failing GSIBs. But I mean, there's some work to do here to in implementing the key attributes fully and strengthen the credibility or restore credibility of the regime. So.
Thank you so much, Eva. That was superb. Sorry for pushing you at the end, but that's my thankless role here. And there are so many questions. So first, let's go to Jérôme.
Thank you, Nicolas. Just a quick clarification for full disclosure purposes. You mentioned that I was a witness to the Credit Suisse crisis. Unfortunately, I was slightly more than that because we had some investments in Credit Suisse. So maybe my comments are not 100% independent and unbiased, but I will still try to do my best. The first thing I would like to comment on is something, a point Eva made, and I've seen it made in all the reports that have been published on the topic, which is the link between resolution and bail-in, which is something I'm a bit struggling with, because it's been said repeatedly that a resolution framework for Credit Suisse would have meant a bail-in of the TLAC bonds, of the MREL bonds, or whatever you want to call them. And I just don't understand this point because as far as I know, there is no direct link between resolution and bail-in. You can very much do a resolution on a bank without bailing in senior bonds. So I think ultimately the point which was made by the Swiss authorities saying that they did not want to impose resolution because they did not want to impose losses on TLAC bonds is not completely correct. And my opinion is that this touches on something which is extremely important, and which is that there is still strong reluctance in many countries to impose resolution in difficult cases. We've seen this in the past, of course, in Italy with the Venetian banks, or with the case of Banca Tercas, which Nicolas, you know very well. We've seen this in other countries. Ultimately, at the end of the day, it's very much a political discussion. And often politicians, I feel, have problem with some specific items of resolution, and which is why they tend to try and find loopholes or use different legal routes to achieve some of the objectives of resolutions, but not the ones that they don't like. And in the case of Credit Suisse, I think the goal was pretty clear. They were a bit annoyed by the fact that the largest shareholders of Credit Suisse were actually also the largest clients of Credit Suisse, Middle East investors, which were a very large client of the wealth management business. And it was complicated for them to have straight losses for those shareholders, especially as many of them had invested very late in the process when they were basically called for help after the first crisis materialized in Q4 2022. So here, I think one of the lessons we should still bear in mind, and it's a bit disappointing, is that there is still some willingness all over the world, actually, to avoid the resolution framework, which has been implemented legally, but has still some drawbacks, apparently, from a political point of view. And this is why also I think investors were wrong-footed on the wipe-out of additional Tier 1 bonds, whereas equity was not completely wiped out, which is not what normally you should expect in a pure resolution framework, where the law is very clear that equity has to be wiped out before additional Tier 1 bonds. So yeah, I would say that was my first comment, both on the presentation and generally speaking on what happened in March last year. Second point I would like to make is the very nice chart Eva showed about how specific all this was to Credit Suisse. And when you look at all the conduct issues which are on the chart, on the price chart of Credit Suisse, funny enough, of course, Eva only showed a few items of the very long list of conduct issues which Credit Suisse had. And I think if she had showed all the conduct issues of Credit Suisse, would not be even able to see the price chart anymore, because it will be all over the chart with no room left for anything else. Credit Suisse was really a mess. We've been discussing liquidity, we've been discussing common equity Tier 1, solvency, everything. But at the end of the day, I think liquidity is always something that can be solved. There's a political will, and if the bank, of course, is viable and has a decent business model. We've seen this for Greek banks, basically, which were on emergency liquidity assistance for many years, and at the end of the day, it worked. Now they are back to a pretty decent standard with solvency and profitability. So this can be managed. The problem of Credit Suisse was culture, was the fact that basically the bank was kind of rotten to the core, something we discovered very late, but something we eventually discovered. So the point I would like to make here is that I think we don't have enough supervisory efforts and transparency on this. I understand the point Eva made about what happened when, for example, the failure of publishing the report, the annual report, and the delay triggered some market reaction and everything. But at the end of the day, the whole point of transparency, it's to trigger a market reaction. It's like when you publish bad results, it's to trigger a market reaction. We need those market reactions because we need the market to be able to act as some kind of pressure on the company to behave properly. And this is something really for which we have very, very limited information in the investor community. Everything which is related to culture, to conduct, to enforcements is extremely secret. We don't get much information. And the problem with the secrecy is that some of it eventually comes to the market, so the market is aware, but the market is aware in a biased way. And the best example I can give of this is the whole thing, the whole story of Credit Suisse, of the collapse of Credit Suisse, was triggered by a tweet from an Australian journalist. If you remember, that was, I think, in September 2022, something like that. The tweet was very cryptic. It just said, a reliable source tells me a GSIB is on the brink. Okay, it doesn't mean much. I mean, there are 20 plus GSIBs, could be anyone else. But everyone understood it was Credit Suisse. Everyone. So this is the problem, everyone knew there were problems about Credit Suisse, but no one knew exactly what, because we didn't have any information. And everyone knew there was something probably wrong. Of course, not to the point that it was on the brink of collapse. Nobody really believed that at the time. but still it was Credit Suisse which came on everyone's mind. So this is the problem. We need more transparency on this. And it's interesting also to contrast this with what happened with Deutsche Bank, because if you remember, going a bit backwards in time, Deutsche Bank used to be the problem child of European banking, and we had loads of tweets about Deutsche Bank being on the brink of collapse and Deutsche Bank having zillions of derivatives, and none of this led to anything dramatic as Credit Suisse. So tweets by themselves are not enough. It's really the true culture of the bank, which ultimately here was the key driver, not solvency, not CET1, not liquidity ratios. It was the culture, and we need more efforts on the enforcement and on the actions of supervisors, because the market can't really do anything because we don't have the information. A third point I would like to make, and also something Eva touched upon, which I think is very important, is national preference. This is again a case of resolution / bank failure / rescue plan, or whatever you want to call it, where ultimately at the end of the day, the white knight is from the same country. It seems there is a very strong support, very strong bias from politicians to, at the end of the day, find a solution which is purely domestic. I mean, it's fairly easy to understand why. A better control on the management, a better knowledge of the management teams, of the culture of the banks which are going to be merged. Of course it's easy to understand, but there are risks to this, and of course the Swiss case is the most obvious one, because like Eva said, what's after UBS? Who's going to take over UBS if there is a problem with UBS? I'm pretty sure it's not going to be a Swiss bank, because there is simply no Swiss bank big enough to take on UBS. So in a kind of absurd way, this case shows again that national preference is often the preferred option from politicians, but that it can't go on forever, because at some point someone is going to hit a roadblock. And I think we need to think a little bit more about why is preference always the solution, and what can we do to prevent this, because I don't think ultimately the interest of diversification and risk reduction and systemic risk reduction. A similar item I would like to mention, international cooperation. Again, an important item developed by Eva. I think clearly the efforts on that front have been spectacular. If you compare it to a decade ago, it's just not the same world. But sometimes I'm worried this is not enough, because even if you cooperate as much as you can, you get to real legal hurdles and legal problems that can't be solved simply by cooperation by various government agencies, whatever the actual role. But this is something which we discovered with Credit Suisse, and I don't think many people were aware, because it was only revealed in the in the FSB report, which is that the SEC, the American SEC, had a major problem with basically the European resolution regime. So not only the Swiss one, we could have had exactly the same comments with any European bank, which is that basically you can't convert bonds into shares over the weekend in the US. And every single European bank out there has the same kind of problem, because all resolution plans in Europe are based on the fact that those bonds that were issued precisely for that could be converted into equity in a resolution situation. So we have a big problem here.
That's right. Sorry to interrupt again, but that's for comprehension. That means that when you convert those bonds, you issue shares, and that requires an authorization by the SEC, or actually in practice a waiver from the normal procedure from the US Securities and Exchange Commission, correct?
Which they say they would not give preemptively, so basically it means you can't do it.
Oh, and here there is a scope for discussion, because what the FINMA says and what Eva's report also says is that probably they would have given the waiver, but they don't set it in stone, as you said, before a crisis emerged.
Yes, and is it something you really want to find out in 2 days with some kind of uncertainty over your head? You know, it's complicated to.
I'm sorry, because I completely failed in my role as a timekeeper here. So it's a systemic failure of the authorities that was supposed to be in charge. So we have a parallel to our actual topic here. But I'd like to move on to our discussion, and we already have a number of questions from the audience, and they're really good questions. So why don't we start with the question about the conversion of convertible capital. Stephen Cecchetti asks, do you believe that any investors in convertible bonds or TLAC MREL believe they will be converted into capital? If they don't, how do we create a regime where investors actually believe a GSIB will be put into resolution? So maybe I'll start with you, Jérôme, on this. Also about the story of the AT1 market, because the report, which was Eva's report, which was published in August of last year, says the Swiss AT1 market is damaged, but since then it has recovered, or at least that's kind of what it looks like. So can you get us into this debate on subordinated capital instruments and how they look like in the light of Credit Suisse, answering Steve's question?
So just to clarify, because it's important, there are 3 types of instruments here. There are additional Tier 1 bonds, which are almost like capital. I don't think any investor in additional Tier 1 bond would doubt that conversion could happen. I think it's pretty clear in everyone's mind. If something happens, those will be converted or wiped out. Nobody doubts that. Tier 2 bonds are the other layer of bank capital. I would say it's more or less the same. I don't think any serious investor in those bonds doubt that if there is a problem, they will be wiped out, converted, reduced, whatever, something bad. Senior debt, honestly, it's more complicated. And I'm not only talking for myself, of course, I'm also talking for all the investors and clients that I know and who invest in our funds or in other funds. And clearly, the fact that there are still called senior bonds, the fact that there has been no significant losses for those types of bonds in the past, the fact that the rules around subordination in bankruptcy versus subordination in resolution versus subordination in the capital hierarchy are very complicated. I would say the jury is still out, and there are still many, many investors who believe no one will ever touch senior bonds. That's for sure. It's not something which is yet completely widespread, and people still believe, some people still believe that by investing in senior bonds, they are safe.
Basically, I'll give the floor back to Eva after this, but on a binary question, Jérôme, if the Swiss authorities had gone for resolution, and if, assuming that, as they have said, that would have involved bailing in senior bonds, or what they call bailing on bonds report, would that have triggered market turmoil? Yes, no?
Yes.
Okay, Eva.
Well, I'm seeing a few questions, and I try to be very concise and addressing them all. And I also wanted to just briefly address this question Jérôme raised. Well, could we have had bail-in could we have had resolution without bail-in? Sorry. And I think the issue was, and FINMA is a very lean supervisory resolution authorities compared to others. They had really focused their planning on a single resolution strategy, that is this open bank bail-in resolution strategy, where they do the conversion over the weekend, and then you have the phoenix raising from the ashes, essentially the same entity, and then of course with the loss of trust, the question was what would have been the business model here, how you recover confidence, and here I think this is the point that it's been argued they could have done this takeover also in resolutions, but or they could have they have a bridge bank power, the power to set up a temporary bridge bank, take over the operations, and then maybe sell operations, do a public offering, also find more than one buyer. I mean, they could have had more time, but I mean, all these resolution options require preparation, and I mean, you can't pull this off in a very short period of time. And I think the focus has been very much on this one strategy, and probably the lesson learned and this single point of entry strategy, and maybe realizing, I mean, the size of the institution. I mean, the question is, should we consider as option closed bank bail-in instead of open bank bail-in using a bridge bank? And even, I mean, this is maybe I have to be careful what I say, you know, more than one point of entry, recognizing just the complexity of these operations. So I think here there is need to think in options, in modules, and having more modularity. And then there is a question here. Let me see. I see, or should I just briefly read the questions from Martin Helvig? Great to see Professor.
I'm feigning even more because now I'm bypassed in filtering the questions. But Martin is asking whether FINMA had sufficient resources. So you already kind of answered by saying it was a lean organization, and which I took as meaning no. And second, FINMA has broad enforcement power. So why didn't they use their Pillar 2 authority?
I mean, maybe I put it, it was sort of a very general legal basis, which you could interpret as giving them powers to do all sorts of things. But at the same time, I think it was, maybe I could have also said it wasn't sufficiently clear what they should do when. And so my point was, I mean, you need to actually be specific.
To expand on this, isn't that the whole point of supervisory discretion? I mean, the Basel Committee says you have Pillar 2, the supervisors can make judgment, impose additional requirements or additional measures. So is the fact that it's defined in a bit of a vague way, is that a feature or a bug? Isn't that necessary for supervisors to feel empowered to exercise discretion?
Clearly, yeah, this is important. But I mean, Jérôme also made the point about transparency and you know, having in a way a rules-based system where you know what happens when, and you know, you have a recovery plan. You know that if certain triggers are met, certain actions need to be taken. So, you know, having more predictability about early intervention and also more transparency. And as I fully agree with Jérôme that, you know, if you have everything mailed public, of course, there is a market reaction. But if this market reactions happens as a point where you can still turn things around, it's a positive thing. As in the case of Credit Suisse, I mean, everything happened in a way too late.
Can I make an additional comment on this, Nicolas? We're talking a lot about Switzerland and about their, you know, supervisory enforcement and what they could and couldn't do. But let's not forget the US. I mean, the main problem of Credit Suisse was in the US. Let's be clear about that. You know, the conduct issues were 95% in the US.
In the UK, right?
Sorry?
Not so much in the UK.
You think about the UK because of Green Seal?
I don't know. I'm just curious.
But you know, the business lines responsible for the problems were not in the UK. It was really mostly in the US in terms of business line. You know, in terms of the business and the reporting and the
I mean, it's an interesting way of thinking about it, right? Should we think of the supervisory failure in Credit Suisse as being a US security failure, supervisory failure then?
It's clearly both. You can't completely discard what happened in the US and pretend it's only the Swiss fault because they don't have enough. I mean, there are very strong points in the various reports, including some Eva mentioned about the fact that FINMA probably doesn't have enough power, in terms of enforcement, in terms of capacity to act on senior officers, and in terms of imposing fines, which are really ridiculously small in Switzerland. So there are some issues in Switzerland for sure. But
US issues, just to expand on that, the main supervisor would be the New York Fed, right?
In the US?
Yeah.
Yeah. Yes.
So that's an interesting angle. We also have this question about the crisis management group, which was asked by John Roche on, was the crisis management group too narrow? I know the ECB has complaints about not being part of it. So that's the people who do the resolution planning, right? And that was only Switzerland, the US, the UK. So what do you think about that, Eva?
Well, I mean, I think this is clearly a point to be considered in the future. I mean, in crisis, clearly the focus was on those jurisdictions where there were truly material operations, and the close cooperation amongst few authorities worked very well. But when it then gets closer to the actual resolution execution, the question is to what extent and who needs to be aware of what is happening, given the impact, potential impact of the resolution actions in jurisdiction other than those represented on the crisis management group. And we have seen and we have heard some reactions in Asia as well as in Europe. So all jurisdictions that are not represented on the crisis management group.
So I'd like to come where, unfortunately, time flies. I'd like to come back to something Jérôme said, which is national preference, right? The fact that UBS was basically given a form of exclusivity in the process. Was there any indication that other banks or other buyers might have been interested in the same kind of deals that UBS got? I mean, of course, that's a bit backward looking, and I don't know, Eva, how much you are willing to go into the forensics, but was there a form of unfairness of treatment which would have been redressed in a proper resolution process, or is that the wrong way to look at it?
I mean, there have been some talk about, and I don't want to go into this where there are other interested parties. It's not, don't have any information on it. It's not in our report. Truly, I mean, if there is a merger takeover, and to prepare it takes time, due diligence, and doing it on a cross-border basis necessarily would require more time. And that's, I mean, that's why, again, I come back to these alternative resolution approaches, maybe having a bridge or to have more time to consider more than one buyer. I think that clearly was a problem that there was just a single candidate to take over Credit Suisse, and no competition of having some bidding process and with more than one potential interested parties.
Nicolas, maybe a comment on this. I mean, I'm like Eva. I was not party to any confidential discussions on this, but there was some reporting by the Financial Times during the weekend about that, and some people who landed from America over the weekend and were sent back by the next plane very quickly to their home country. So I think there are some people who are aware of what happened, and I think some FT journalists could probably tell the story.
Okay, that's some pressure on the media if they're listening to us. One other question, which was asked by William O'Connell, Eva, that's for you, is on the securities law issues and what we discussed about the SEC and executing a bail-in. So the question is whether there were discussions on this issue during the international standard-setting process, or what did that emerge completely by surprise?
I think it had not been, it's not entirely surprising. I mean, the FSB issued a bail-in execution report, which identified those issues. And there you can see also the comparison between the different bail-in approaches in the US, closed bank bail-in in the UK and in Europe. The Swiss approach being similar to that of most GSIBs in the banking union. And so that had been anticipated, but probably, I mean, we have not, since we have never come to so close to executing it, seen that the practical implementation is challenging. But just to be clear that, I mean, FINMA had confirmed that actually all the preparations had been meet the SEC requirements. And maybe just to the way understood US law is that a bail-in would actually be characterized. I mean, the concept doesn't exist in US securities laws. It would be compared to a sale, in which typically requires a prospectus, but there are certain provisions that allow an exemption from this prospectus requirement, because that prospectus that would take weeks and weeks to implement it. So it's important to obtain an exemption and to meet the conditions for the exemption, but the SEC will only confirm at the point of, bail-in or in resolution whether or not these conditions are met. So there is a residual uncertainty here. And in addition, there are certain, even if this exemption is met, there are certain disclosure requirements. So Monday morning, there needs to be a pro forma financial statement. And I mean, meeting these disclosure requirements may be challenging just over a weekend where you're bail in the bank and you have to come up with value statements, and if there is any error or misstatement, I mean, there are potentially criminal sanctions attached to this. So legal and execution risk certainly cannot be completely disregarded, but should be manageable. And I think this is also an issue that is being discussed at the international level now.
It's sad because we're already at the hour and there are so many other things we should discuss about this. I have tons of questions. There's a very interesting point made by Mark Dobler in the Q&A on the cascade of losses. We won't have time to, there are also questions by Uday Birdas and Tim Clausen that I won't have time to raise, but maybe just, Jérôme, you have the last word. What should we remember from all this?
Yeah, last word is going to be about something we didn't discuss, which is communication from the authorities, which is a tricky one because, of course, we had the statements from FINMA about, everything was fine or kind of fine and solvency was fine, blah, blah, blah. And then at the same time, a few months later, we learned in the reports that there was a data room which was ready and had been ready for months to prepare the distressed sale of Credit Suisse, So it's quite evident that all information cannot be shared to the market. But this is a problem because at the end of the day, it raises issues of trust and credibility. And I think at some point we will need to have some strict guidelines and rules about what the authorities can say and cannot say under such scenarios, under such very critical circumstances, because for the time being, it's a bit of a jungle. And from the investors community point of view, it's very difficult to navigate.
Well, that's powerful. Just on this, Eva, just factually, so there was your report of the expert groups. There was a report from FINMA last month. What else is expected? I mean, leaving aside the lawsuits, of course, but there is a parliamentary investigation committee coming up and a government report. What are the next steps?
Yeah, I can't give you the exact timeline, but basically these are the two reports that should be coming fairly shortly. This is for once the parliamentary inquiry, which should be more, maybe somewhat more backward looking, but then there will be a report coming from the government and the finance ministry, maybe setting out proposals for the way forward for the too fail regimes, and with some ideas of potential reforms to be explored. And yeah, that too we should be expecting in the coming, I don't know, week or month.
I was slightly mischievous earlier in the session when I mentioned that, Eva, you had been at FINMA and then at the FSB, so you have a lot involved in your previous experience in this whole story. But I want to express my gratitude, actually, for you to have come to talk with us on this and sharing your views, because there are many difficult questions here. So it's really incredibly valuable for the audience of this series to have you here. So thank you so much. Thank you also so much to Jérôme for expected candor, but that was great. And this was an incredibly illuminating session, at least for me. I hope for the audience as well. We will come back to this issue because, as was mentioned at the end, it's not the end of the story. There will be more coming up, and it's an incredibly important precedent. First GSIB under the new regimes that Eva created, and we'll have the next session on a related but different issue, the agenda of the Basel Committee that will be on January 25, with Naileh Shaw's Secretary General of the Basel Committee. And in the meantime, again, Happy New Year, and thanks for joining us today. And many, many thanks to Eva Hüpkes and Jérôme Legras.
Thank you, Nicolas. Bye-bye.
Goodbye. Thank you.